Welcome back to Talk Tickers. If you're tuning in, you're here for the signal, not the noise. You want to know what really happened on the print.
Not just the headlines.
Exactly. And today we are tearing into Alcoa Corporation, ticker AAA. We're covering the fourth quarter and full year 2025 results.
It's the industrial bellwether. Alcoa really sets the tempo for the entire materials sector.
So let's set the scene. It is Friday morning, January 23rd, 2026. Alcoa dropped their earnings after the bell yesterday. And if you were watching, you saw the stock pop.
Oh, yeah, it ripped.
It was up, roughly 3% almost immediately, but then things got a little weird.
You just stalled out. The momentum completely evaporated.
Right. We're hovering around $63.14 this morning, and it feels like the market got excited, took a breath, looked under the hood, and said, wait a minute.
There are a lot of moving parts here.
Yeah. Why did that rally die so fast?
This is a classic quality of earnings issue. On the surface, the headline numbers are spectacular.
Yeah.
But when you start stripping away the layers...
The tax benefits, the credits.
Exactly. The accounting adjustments, you realize that while the business is healthy, the beat wasn't, entirely operational. Investors are wrestling with this tension between the complexity, the accounting, and the future cash flow.
Complexity versus cash. I like that. Okay, let's hit those headline numbers, but I want to push back on them. Adjusted EPS, $1.26. The street was at $0.93.
Massive beat, about 35%.
But whenever I see adjusted in big, bold letters, I get skeptical. Is that $1.26 real, or is it just financial gymnastics?
It's a mix of both, to be honest. The number is real. It follows the rules, but it definitely includes some one-time benefits that won't happen again next quarter.
Okay.
Revenue was $3.45 billion, beating by about $170 million. And adjusted EBITDA, that's the number everyone watches, came in at $546 million.
Which is a sequential jump of $276 million. They basically doubled their EBITDA from Q3. That sounds incredible.
Too good to be true, maybe.
That's what I'm asking.
On paper, it looks like a rocket ship. And look, a lot of that is real. It's driven by aluminum pricing. But the reason the stock didn't just break out is because the smart money is asking, how much of that $546 million is repeatable?
And if you strip out the one-offs...
The core earnings are quite a bit lower.
Okay, let's unpack that. This is why we're here. Let's deconstruct the beat. What actually happened in the financials to, juice these numbers? I saw something about CO2 compensation that seemed convenient.
It was certainly timely. There were three big non-operational levers pulled in Q4. First, that's CO2 compensation. We see this with European industrials. Alcoa got a big benefit from schemes in Norway and Spain.
Right.
Specifically, in Norway, they had a rule. They had to spend 40% of their government compensation on emission reductions.
Okay, so you have to spend money to get money.
In a way, yeah. But here's the kicker. They met that spending requirement in Q4. And because they checked that box, they got to recognize a $25 million offset to their R&D expenses immediately.
So $25 million just vanishes from the expense column because they filed the right paperwork.
Effectively, yes. It flows straight to EBITDA. It's not because they sold more aluminum. It's because they qualified for a credit.
Okay.
Then you had the tax situation in Brazil, which is even bigger. A massive $133 million benefit from reversing a valuation allowance on deferred tax assets.
Whoa, hold on. Reversing a valuation allowance on deferred tax assets? Can you translate that for the rest of us?
Think of it like this. Imagine you had a gift card for $133 million that you lost in a drawer. You assumed it expired, so you wrote it off your personal balance sheet.
It's worthless.
Right. Then suddenly the store, in this case the Brazilian tax authority, says, actually, since you're making money again, this card is valid.
So you just find the gift card and put it back in your wallet.
Exactly. The accountants get to add that value back to the books because the Alumar refinery is profitable again. It's a huge boost to net income. But, and here's the catch, it's not cash.
Right. You can't use a tax credit to pay your light bill.
Precisely. The EPS explodes, but the bank account doesn't feel it.
And there was some ugliness too, right? A goodwill impairment.
Yeah. $144 million.
Yeah.
In the Alumina segment, it relates to an acquisition from way, way back in 1994. They basically wiped out the remaining goodwill there.
So they're just cleaning house.
That is the perfect way to look at it. It's a messy quarter. You have tax credits appearing, goodwill disappearing, CO2 offsets. It's a lot of noise.
It sounds like an accountant's playground, but let's look at the cash. Amidst all this paper shuffling, how is the balance sheet actually holding up?
The balance sheet is actually the fortress part of this story. They ended the year with $1.6 billion in hard cash.
Okay.
And they redeemed the last of their 2027 notes, about $141 million.
So debt is coming down. That's undeniably good.
It is. Net debt finished at $1.5 billion.
Yeah.
Now, there's some nuance here. That's at the very high end of their target range.
Which is 1 to 1.5 billion, right?
And management was very specific on the call. The goal is to stay within this range through the cycles, not just touch it.
And didn't they drop a warning about Q1 cash flow? I feel like that really muted the reaction.
They did, and this is critical. Q1 is historically a cash consumption quarter for Alcoa. You've got working capital builds, big tax payments due.
So cash goes out the door.
A lot of it. They explicitly warned that net debt might tick up temporarily in Q1, potentially going above that target range.
So if we see the debt load rise in April, we shouldn't panic.
Correct. They are telegraphing the punch. They're telling us we're going to burn some cash, but it's seasonal.
Got it. Okay, so that's the financial engineering. But Alcoa makes metal. Let's talk operations. The pricing story seems to be the real hero here.
It is. I mean, you can strip out the tax credits, but you can't strip out the fact that the prices of aluminum went up. Higher LME prices for sure. But crucially, the Midwest premium shot up.
Okay, I see Midwest premium everywhere. I know it went up, and that's good. But for someone who doesn't trade commodities, what is it exactly?
Think of the LME price as the base price of a car at the factory. The Midwest premium is the cost to get that car delivered to your driveway in Detroit, plus a markup because there are no other cars on the lot.
So it's about physical scarcity in a specific region.
Exactly. It covers logistics, transport, and most importantly, how tight supply and demand is right there in the U.S. Midwest.
So because there isn't enough metal physically sitting there, customers have to pay extra just to get it.
Precisely. And for Alcoa, this is pure margin. They produce metal in the U.S. or Canada, so they just collect that premium on every single ton. It was a massive driver of that EBITDA growth.
And they are making a lot of tons. I was reading the operational highlights records breaking everywhere.
It's impressive. De Shambot in Canada, that's 16 consecutive years of production increases. Moshean in Norway, 8 straight years of records. They hit records at 5 smelters and 1 refinery.
So the plants are humming.
They are absolutely humming.
Except for one. Let's talk about the problem child. San Ciprin in Spain.
Ah, the San Ciprin complex. The restart that feels like it's been going on forever.
Where are we at with this thing?
It's progressing. They reached about 65% capacity by the end of 2025. The full restart should be done in the first half of this year, 2026.
But the economics, I looked at the guidance and it sounds painful. Why are they restarting a plant that's hemorrhaging money?
That is the multi-million-dollar question.
Yeah.
The economics right now are a drag. No sugarcoating it. For 2026, the combined complex is expected to post an EBITDA loss of $75 to $100 million.
Oh.
And it gets worse. It's going to consume $100 to $130 million in free cash flow.
So we are burning over $100 million of shareholder cash this year on one asset. Why not just shut it down?
Because of the long game. The thesis is that it will be profitable once it's fully ramped and stabilized. But for 2026, it is an absolute anchor on the entire company.
Is that why they're trying to sell off those other assets, the transformation sites?
Partially, yeah. They want to monetize that non-core real estate to plug these cash holes, but that's also delayed. They're now hoping for a deal in the first half of 2026.
It's all so complicated.
Well, these aren't simple land sales. They involve multi-year payment streams, value sharing.
Yeah.
It takes time. But until those sales close, the cash drain from Spain is front and center.
Okay, let's pivot to the future. Let's look at 2026. What's the guidance telling us?
Production-wise, alumina is guided at 9.7 to 9.9 million tons. Aluminum is 2.4 to 2.6 million tons. That's up, mostly because of San Ciprin coming back.
But here's the part that I think spooked the market. The bridge to Q1. We just had this massive beat, but Q1 looks like it's going to be a serious hangover.
It is a steep come down. This is the bear case in a nutshell. The alumina segment, they expect about a $30 million sequential EBITDA decline.
Okay.
But the aluminum segment, that's where the pain is. They expect a $70 million sequential decline.
$70 million. Dropping off the bottom line in one quarter.
It's the noise going away. Those CO2 credits from Q4, they don't repeat. You don't get to find the gift card twice. Plus, as San Ciprin ramps up, the costs hit before the revenue fully catches up.
So Q4 was a high water mark we shouldn't expect to see again for a while.
Exactly. It's at a bar that they just cannot clear in Q1.
Got it. Okay, let's zoom out. Let's talk macro. The setup for aluminum is fascinating right now. Supply and demand seem to be in a vice grip.
It's tighter than it has been in a decade. If you look at inventory levels, days of consumption, we're at the lowest levels in 15 years. The cupboards are bare.
And China. Aren't they usually flooding the market?
Not this time. They're strictly capped at 45 million tons for environmental reasons. They're hitting that ceiling. Now, you'd look to Indonesia for growth. They're adding about 700,000 tons. But
There's always a but.
right. Disruptions in Iceland and Mozambique are taking about 550,000 tons off the market.
So net supply growth is basically flat.
Almost zero. In a world that needs more aluminum for EVs, the grid, defense, it's a recipe for price support.
And then we have the tariffs. How does Alcoa play that?
They're actually uniquely well positioned. Management confirmed that the Midwest premium has risen enough to fully offset the tariff costs for their Canadian imports.
So the customers are just eating the tariff.
Effectively, yes.
Yeah.
And remember, Alcoa owns 2 smelters inside the U.S., Moshean and Wark. Those plants are printing money because they get the higher price, but pay no tariff.
And they just locked in power for Moshean, right?
They did. A long-term green power contract, 10 years, plus a 10-year option. That secures that plant for 2 decades. It's a huge win.
Let's talk Europe. CBAM, Carbon Border Adjustment Mechanism. It sounds like boring bureaucracy, but Alcoa claims it's a gold mine.
It sounds boring, but the game theory is fascinating. Starting in 2026, importers into Europe have to buy certificates to cover their carbon. It's a carbon tax. Alcoa expects this to be a net positive of about $10 a ton for them.
How does a new tax become a benefit?
Because the market price, the Rotterdam premium, will rise to cover the cost for the dirty competitors. Analysts think the premium goes up about $40 a ton. But Alcoa's European smelters use clean hydro. Their emissions are tiny.
I see. So their cost might only go up $30.
But the price of the metal goes up $40 for everyone. They pocket the spread.
They win because their competitors are dirty.
It is pricing power derived directly from policy, a regulatory moat.
Speaking of moats, what about ELYSIS, the zero-carbon aluminum? Is that happening?
It is the holy grail, but the grail is still far away. They started the first industrial-sized cell, which is a huge milestone, but the CEO was super clear. Do not expect a commercial ELYSIS smelter groundbreaking until after 2030.
So no greenfield growth. And for listeners, greenfield is a new factory, brownfield is expanding an old one.
Exactly. No greenfield plants planned anywhere. Energy is just too expensive.
Which brings us back to that tight supply. If nobody is building new plants,
Then the price has to do the work. It's the only valve left.
All right, that brings us to the part of the show everyone waits for. This is the not financial advice segment.
Time for the disclaimer.
Standard disclaimer applies. We are 2 voices in your headphones. We are not your financial advisors. Do your own diligence. This is for entertainment only.
But if you buy a yacht, feel free to send a thank you card.
We accept postcards. Okay, what do you have for us?
I'm calling this trade the 2027 San Ciprin cash clawback.
That sounds like a spy novel. What's the thesis?
Okay, so right now, the market hates San Ciprin. We just talked about it. It's burning $100 million in cash in 2026. It's an anchor on the stock.
Cash incinerator.
BUQUT.
Yeah.
There is a hidden catalyst buried in the Spanish regulatory fine print. In Spain, for that CO2 compensation, you don't get the cash when you earn it. You get it 3 years later.
3 years?
Yes. So Alcoa expects a massive check, about $85 million, to land in their bank account in the second half of 2027. And that cash relates to the production they're doing right now.
So it's a huge delayed rebate check.
A huge one that the market is completely ignoring because it's too far out. So here's the play. You look at long-dated calls, late PS, for late 2027 or early 2028.
Why late PS? Why not just buy the stock?
Leverage. Leap PS give you control of 100 shares for a fraction of the price. But more importantly, you need the time. You need the expiration date to be far enough out to capture that 2027 event.
Okay, so lay it out. What happens in late 2027?
You are betting on 3 things converging. 1, San Ciprin finally hits breakout and stops the bleeding. 2, that hidden check of $85 million clears, causing a massive free cash flow spike. And 3, the narrative on Wall Street shifts from cash burn to cash neutral, which re-rates the multiple on the entire company.
So you're betting on a zombie asset coming back to life and finding a bag of cash under the mattress.
Precisely. It's an arbitrage on regulatory accounting lags. The market is pricing the pain of 2026 today and ignoring the reimbursement of 2027.
And the risk?
The risk is it is a zombie asset play. If energy prices in Spain spike again, the plant shuts down, the thesis goes to zero. It's high risk, high reward.
I love it. It's wild, it's specific, it's buried in the footnotes. That is exactly what we look
The
for.
definition of deep value.
All right, let's wrap this. Alcoa delivered a beat, but it was noisy. Q4 was pumped up by credits and tax reversals.
The lost gift card.
Right. And the Q1 guide is a cold shower with a big drop in the aluminum segment expected.
But looking past that noise, the macro is bullish. Flat supply, tariffs, and a net benefit from European carbon taxes. The big risk is just getting through this San Ciprin restart.
Keep an eye on that debt level in Q1, watch the aluminum spot price, and don't take your eye off the Midwest premium.
And the bauxite prices, they're creeping up.
Always the bauxite. This has been Talk Tickers. We hope you found the signal. Do your own diligence. We'll see you on the next print.
Stay curious.